How do I calculate true cash flow after expenses? So for this, we'll talk about a single family home. You have your rental income, and you might have any pet rent or anything like that, but you take all your income, and then assuming you have a debt service, you will have your debt service, which is your mortgage. You have taxes, insurance, you might have an HOA fee, and then you typically will want to factor in your vacancy, your maintenance, and if you're hiring property management, you want to have property management calculated as well. Typically, what that looks like is there's something called DSCR, and that's debt service coverage ratio. In my experience, banks and lenders in general will generally want a 1.2 to 1.25 DSCR ratio. So this is sort of a litmus test on cash flow for your property. And what the banks are saying is if you can bring in 1.2 or 1.25 minimum DSCR, then we are comfortable lending on this asset. So that means that you're bringing in essentially 20 to 25% more than your expenses. And they will look at PITI, the principal, interest, taxes, and insurance. They'll look at that cost. And then the extra 20 to 25% they are factoring in for property management, maintenance, vacancy, etc. And so they're saying, assuming they know all that stuff is going to happen, and then they know your income based on the signed lease and what that is obligated to generate. And then they'll look at your expenses, again, the PITI, and then you should be bringing in, when you look at your PITI, you should be bringing in 20 to 25% more than that, which should accommodate for the extra maintenance and property management, etc. So if you run your DSCR and you're at 1.2 or 1.25, I personally think that's the minimum you should be at. Above that, you get healthier and healthier when it comes to cash flow. Now, I think it is important for landlords to understand that building a rental portfolio can scale your cash flow very nicely. Having a small rental portfolio is wonderful for your wealth, but it's unlikely to give you significant cash flow unless you've inherited these properties and they don't have any debt service or anything like that, or they're already paid off, but at that point, you already know the game. So let's say you have 4 rentals and they each cash flow $400, $500 a month. That's awesome. That's great. Now, obviously, it depends on, are they $5,000 rentals? Then maybe that's a bit narrow. But assuming they're normal rentals for the Richmond market, that's a pretty solid cash flow per property. You have a big repair. Let's say there's a main line has to be replaced, or there's a big water damage, or you need a new roof or something like that. That's going to wipe out your cash flow for a year. So it's okay to buy rentals and benefit from the cash flow, but I don't think you should count on it. Buying rentals is a wealth generation tool that is absolutely generating wealth. If you need capital, you might want to get into the transactional real estate investing first, build that capital, and then focus on generating wealth for your family and for generations to come by owning rentals. And so it's not to say that rentals cannot cash flow. I have cash flowing rentals that do pretty well. And once you achieve a certain scale, they certainly will cash flow because they pay for themselves and things like that. But if you have a smaller portfolio, it's going to be more difficult for them to cash flow, to keep up with repairs that happen over time and things like that. But it is to generate wealth. Another important thing to consider is including reserves for long-term repairs like CapEx, capital expenditures. So replacing HVAC units, replacing the roof, things like that. So you have your cash flow and you could be building up the money in this bank account and stuff like that from your cash flow, which is great. But be sure that you're mindful of longer term CapEx repairs that are needed. You might need to replace an HVAC unit in 5 years. Your roof might have 10 years left on it or 3 years left on it. You want to be sure that a portion of that cash flow is actually allocated to the long-term reserves and repairs as well. So cash flow that you should be looking at, in my opinion, is as long as it's not in the negative and costing you money, you need a healthy margin there of cash flow to pay for property management expenses so that you have all your free time focused on your family, on travel, on your W-2, on anything else that you're doing. And your property covers all those expenses and you're building generational wealth. And so measure your DSCR and make sure that you're at least at 1.2, 1.25 or higher. That will give you a pretty good indication of what your cash flow will be with this property, what it should be, or what you should be looking for when you're analyzing new deals. That's at least the starting point. There's a bunch of other things that you should look at, but that's a good place to start.